connecting to cloud. Okay. Hi, everybody. Welcome to part 9 of our series on personal finance from mystery to mastery. We're on our second to last video in this session. So we've covered a lot. So we're going to be covering the last pillar of personal finance in today's session. And that's going to be around insurance. So insurance is something that is very, very underpenetrated in India. If you look at the statistics, we are one of the most underinsured countries amongst the developed countries, the large economies in the world. So insurance is something that on average, you probably have too little of rather than too much of. So this is going to be a very good session for understanding the basics of how insurance is useful, when it's useful, and how to make sure you are insured to the right level. Before we kick into this presentation, just one administrative update. So next week, in all likelihood, we're going to be doing a webinar for the entire small case user base. So that's going to be a second joint webinar with small case. And so we won't be hosting a Bharosa only webinar. We'll be doing that instead. So I'll send all the members and WhatsApp members and email list holders details on how to join the small case webinar. And that'll prove to be a really, really interesting webinar. I'm going to cover our sort of stock screening process that we use in our small case to manage it. And it'll be a very good crash course on the basics of fundamental analysis for stocks. So highly recommend you join for that. It'll be a very, very good seminar, and there should be a lot of Q&A because we'll be getting lots of small case viewers as well. So now we can dig into today's topic on insurance. Okay, so just a quick recap of what we did last time. We were focusing on our final conclusions on how to use credit properly. Borrowing, as we discussed, is something that a lot of people are scared about, but actually borrowing is a very useful tool. We just have to understand how to use it well. So for anyone that missed our sessions on borrowing, they're all on our YouTube channel and recommend you check them out. So as we discussed, what we're going to be doing today is we're going to be talking about protection. So why do we need to protect our financial health? The pitfalls of over and under insuring. And we're going to do a case study demonstrating how to determine the right amount of insurance for yourself. And we're also going to do a quick intro into some of the jargon that you commonly see in insurance. And then we'll pick up the ball on insurance in our next session in personal finance from mystery to mastery, which will tell you how to use insurance properly and avoid some of the pitfalls that we commonly see people making when they're using insurance. Okay, so let's start very basically here and say, why do we need protection in our financial health? Because really understanding how to use products correctly, first we need to understand what need are these products trying to meet. And in the case of protection, the real reason we need protection is because the future is very uncertain. We don't know what the future holds in store for us. I could be hit by a bus and, then my family has no income stream. So how do I deal with that? I could lose my job. I could have property loss. I could have a health event occur. So all of these uncertainties are things that any responsible person needs to think about contingency planning for how to deal with these uncertainties in life. And we need to make sure that our finances are protected against these unexpected events. So how do we do that? Well, one way is we can reduce the probabilities of these events occurring. So you can be a careful driver. You can always wear your seatbelt. You can not smoke. You can take care of your health. Those things can reduce these probabilities, but they cannot eliminate these probabilities to zero. So we always need to be thinking about how to safeguard our assets, even if we can't imagine these things happening, right? I'm 35 years old. I can't imagine, not being here, tomorrow, but there's always a possibility that happens, right? Life is out of our control. So we must think about how to safeguard our assets appropriately. So how do we do this? So one of the big gaps that I see in people's thinking is sometimes they assume the only tool to protect your asset is insurance, and that's just not true. insurance is a great tool for protection, but there are two other tools that are very, very valuable. And I'm going to cover all three of these tools and also tell you the advantages and disadvantages of each. The best tool for protecting your financial assets is your savings cushion. How much do you have in your bank account? How much do you have as excess funds? And if you're sitting with a big cushion of savings, that can go a long way to protecting you from certain events. So let's take a simple example of, let's say I've saved really well and I unexpectedly have some medical expenses crop up that I didn't expect to happen. If I have ample savings, then no problem. I'll use some of my savings to defray those expenses and I'll build my savings back up once I recover. So savings can be used to protect your financial health as well. And the best thing about savings is it's zero cost. So this is another huge advantage of making sure that you get into the habit of saving as much as you can, particularly early in your life. The earlier you build that savings cushion, the better you're going to be able to use your savings to protect your financial health in the future. The next is access to borrowing. So we covered a little bit of this in our sessions on borrowing, but one of the underrated benefits of borrowing is it helps you manage temporary cash flow issues. Let's say during the pandemic, I lost my job and I didn't have money in my savings to cover my rent. Instead of causing a huge problem, if I had access to a credit card or an overdraft line or whatever, I could use borrowing to help me manage temporary issues in cash flow. So borrowing is a very, very good tool for helping you protect your financial health when you have temporary issues in being able to afford some of your expenses. Now, borrowing is not as good as savings because it's not zero cost, right? When we borrow, we have to pay an interest rate. And also we need to make sure we don't fall into a debt trap. Sometimes, for example, you may think, I'm going through a temporary issue, but if it turns into a permanent issue and you're not able to pay back that debt, it can create problems. So that's one of the drawbacks of debt. But otherwise, it's a great tool for helping you protect your financial health. And then the last tool is insurance. And insurance is a very useful tool in managing costs that your savings cannot cover or you cannot borrow to satisfy. So a good example of this is loss of life, which is why it's one of the most common insurance products we see. The cost of me dying tomorrow is huge when you think about it for my family, because I'm the sole breadwinner in my family. I'm 35 and there's a long income generation period ahead of me. And if I were to die tomorrow, then all that income stream goes away. And so the cost is massive, but the probability that this event occurs is very, very low. So insurance is great for situations like that, where there's a large cost, where savings is not going to be able to support the risk, and borrowing is not going to be able to support the risk. It's not a temporary cash flow issue. It would be a permanent issue. The problem with insurance is it's not zero cost, and you pay whether or not the risk occurs. And so that's the one drawback with insurance. But it's a very, very necessary tool because there are risks like this all over the place in our lives, and we need to make sure that we are cognizant of them. So let's do a quick primer on how insurance works. So let's say I need to protect against a risk. It's too large for me to protect via savings or borrowing. How do I deal with this? So insurance was created to help individuals deal with issues like this. So how do insurers do it? Well, insurers basically collect a large cushion of savings from investors in the company. So they'll issue bonds, they'll raise equity, they'll raise a big amount of capital. And they can then insure risks that individuals cannot because they don't have those savings. So loss of life, big medical expenses, even business interruption costs, all these large risks that people face that they can't insure themselves. Insurers, because they're sitting on so much such a large pool of money, they can actually insure these risks. So the way it works is they agree to pay the insured if the risk occurs. In return, they charge a fee called the premium whether or not the risk happens. So in this example, here I am, and basically I'm saying, you know what, I can't afford to deal with the expenses if my car gets into an auto accident. So I need to pay a fee to the insurer. That fee will be a small amount relative to the cost of what happens if that car gets into a crash. In return, the insurer agrees to pay me if the car gets into a crash. And so in the future, when the car gets into a crash, the insurer is paying me the large sum of money that I need to fix my car. So that's the basics of how insurance works. So let's understand how the insurer is making money. Why is the insurer agreeing to take this risk? He's not he's not doing it out of charity, right? He's making money on this. So this can tell us a few things about insurance. So the insurer essentially is charging customers fees upfront, the premium. And if the risk occurs, they have to pay expenses that they pay out to cover the risk for the customer. That's called a claim. So the fee is called the premium and the payout is called the claim. In order for the insurer to be profitable, they need to charge higher fees, premiums to their customers than they pay out in claims. Otherwise, they won't generate a profit. It's as simple as that. And the way the insurer does that is they calculate the probability. How likely is it for every customer they're insuring to get into an auto accident, let's say? And then how much would they have to pay on average to do that? And then they price the insurance such that that amount they charge is higher than what they expect to pay in the future. So there are two things that determine the price of insurance: the probability of the event occurring and the payout if the event occurs. And we know that the insurer is going to be charging more, right? Because they need to make their profit margin. So what does that mean? So that means that on average, right? On average, insurance is actually costing you money. So should we not take insurance? And the overwhelming answer that I will say to you is no. And the reason why is if you're underinsured, the dangers are tremendous, because even though you maximize your short-term gains because you're not paying the premium, you leave yourself exposed to risks in the future. And these are risks that you cannot take. They're catastrophic risks. It doesn't matter if you think the probability you're going to die is in the next year is 1 out of 1,000 or 1 out of 1,000,000. Because to your family, if you were to die tomorrow, then the risk would be catastrophic. So you have to insure yourself against that risk. And so in circumstances like this, even if it's very, very unlikely, the prudent, responsible thing to do is to take insurance at the right level. So being underinsured is very, very risky. So let's take a few examples. Only one breadwinner in a family, he passes away unexpectedly early in life. And then all the people that depended on that breadwinner are stuck and they can't earn money and they're running into real problems. So clearly that's a example of underinsurance. Another example, you stretch for a fancy car. The payments are so high, you can't afford comprehensive insurance for the car. You get into an accident. The insurer covers the damage you did to the other party, but it doesn't cover your damage. And you can't afford to get another car. So now you've overstretched and you don't have insurance to help you fix the car. So that's a serious, serious problem. You've just lost the car and all that money you invested in the car is gone. So this is another example of what can happen if you're underinsured. And what I'll say is, particularly when you're young, you tend to think you're invincible. And as a result, you tend to miscalculate the probabilities of how likely some of these risks are. So make sure you do some thinking, particularly if you're younger, starting your career, starting a family, etc. You really, really want to make sure that you've thought about how much insurance you're taking on. Okay, what are the dangers of overinsurance? So the dangers of overinsurance are much more subtle. So again, I'm going to go back to the point that we sort of uncovered from the topic of how insurers make money. The key principle is the insurer is making money on average on a customer. Otherwise, it would not be profitable. So that means that every time we sign up for insurance and more insurance, we're actually paying a profit stream to the insurer. And if a claim doesn't happen, that's money that's going away from us and is going to the insurer. So in simple English, that means most customers, the insurance will cost them more than the value they receive, right? So that's okay. We still need the protection because we can't afford to take the risk, but we want to avoid overinsurance because it's costly. So you want to avoid overprotecting and introducing costly expenses when we need to. So let's take an example of overinsurance. You have two breadwinners in a family. The family lives very frugally, such that either salary is enough to cover the expenses. But the family has opted for a very high level of life insurance covering critical illnesses and all these things, even though they have a lot of savings. So in cases like this, the family may not need such a large life insurance policy because there is diversification. You have two people that are earning a lot, right, in the family. So if one were to die, then it's not a big deal. The other income stream will still be sufficient to cover the expenses. You still need insurance, obviously, because what if both were to die or, something like that, but you may not need to cover things like critical illness, if you have a savings cushion and you have two salary streams. Another example, and this is very, very common actually. This is something that a lot of people do. So you may actually be doing this. You drive a very cheap car. It's old. You're thinking about upgrading it soon anyway. You don't care if you have some cosmetic damage in the car. But by habit, you have a comprehensive auto policy on this. This is not really required if you have a savings cushion and you can afford to fix the car yourself. You're just paying extra fees to the insurer. So that's an example of another probably very common overinsurance circumstance. Okay, so that's kind of the dangers of overinsurance. So how do we find the right level of insurance? It's a bit tricky, but I'll walk you through an example which will illustrate how you can do that. The keys are asking yourself, do you need insurance? Can you manage the risk yourself with your savings? Or can you safely borrow to protect against the risk if the risk occurs? If the answer to that question is no, then you know you need some level of insurance. And the way to determine how much insurance you need is to determine what the consequences would be if the risk were to occur. So assume the risk occurs, assume the worst happens. You should size the insurance amount such that your finances are okay if that risk were to occur. So I'll walk you through exactly how to do this in an example in the next slide that we'll cover. And the last piece is evaluate that the premiums from such a policy are affordable for you. And if they're not, then you have no choice but to look at cutting down the insurance in some level. So maybe you won't be able to fully insure the risk, but you'll be able to partially insure the risk. So that's kind of the basic approach of how to look at the whether the insurance is right or not in any situation. I'm going to give you an example here on a very basic example on how to do this in life insurance as an example, just so we can figure out a framework to do it, right? And every circumstance will vary, but I'm just giving a very simple example right now so that you understand the process and math you can go through to do it. So let's take an example. Let's say I'm 35 years old. I have a family where I'm the sole breadwinner. The expenses are 6 lakhs a year, and I expect my family's expenses will increase 5% per year. I want to cover my family's expenses for 45 years in the event I die. I have a current corpus of 20 lakhs. I think I'll be able to generate 7% on my corpus in investment return. How large a policy do I need? Okay, so we understand the goals here, right? The goal is I want to make sure that if I pass away, that my family's expenses are covered for 45 years, right? Because in 45 years, then, and you can make that number whatever you want. But for me, I want my family to be protected for 45 years because by that point, my offspring will be earning and can help support my wife if she needs it. And at that point, she'll be around 80 years old. So let's say that's the policy I want to go with. So we're going to try and figure out how to make sure that the policy I get actually delivers that outcome. So the way that we're going to do it is we're going to use a formula in Excel called the present value formula. And for people that are familiar with Excel, it's basically the PV function. And I'll post the Excel working of this on the website so members can download the Excel and see the exact function I used. But it's a very common function. For anyone that wants to see how it works, they can look on Google and there's tons of literature on how it works. But I'll explain the basics here. So what are the key variables? My current expenses are 6 lakhs a year. My investment rate of return that I expect on any corpus is going to be 7%, right? That's what I put in the last slide. I expect that whatever savings I have, I can invest them at 7% to generate income. And we said, I'm expecting my expenses to grow at an inflation rate of 5%. So if we look at the net return of the corpus, right, how much it's growing above how much my expenses are growing, it's the 7% less the 5%, so 2%, right? So that's the net growth of the corpus when we take into account how fast the expenses are growing. And sorry, here I put 40 years, in the last slide I put 45 years, but let's just use 40 since that's the number I used here. The number of years that I want that corpus to last is 40 years. So essentially what I did is I used the PV formula, right? And the arguments in the PV formula are the rate. So I used 2%, the rate of my investment growth less my expense growth. And the number of periods is 40. And I calculated the present value of the corpus. It needed to be 1.7 crores. I have a current corpus of 20 lakhs. So if I subtract that, I need an insurance policy of 1.5 crores to make sure my goals are met. So that's kind of how you work through the math of sizing the policy. You say, what do I need if the risk occurs to make sure my family is safe? I need to make sure that they can afford their expenses of 6 lakhs, taking into account the growth of 5% for 40 years. And when you calculate how much that works out to, it ends up being 1.5 crores. And the present value function may be a little mysterious to you guys. So I'll just walk you through the basics of how it's calculated, so you understand intuitively what the formula is doing. This is not math that is simple to do without a calculator and without Excel. So you really should get comfortable using Excel to do workings like this. So again, I'm going to upload the workbook on the website, so you'll be able to see exactly how I did the formula. And for people that aren't members, very simple to just go on Google and understand how the PV formula works. But essentially the way it works intuitively, what the formula is doing, so we understand how it's working, is it's based on one principle. If I know I have a future expense amount of X, because because that expense is happening in the future, there is some time that I can actually invest the amount I need to pay for that expense. And because of that, I need less money than that expense to actually satisfy it in the future. So let's work through some examples. So let's say I need to pay 6 lakhs today. How much money do I need to pay it? Obviously 6 lakhs, right? Because I owe someone 6 lakhs and they need it today. So I need to pay them 6 lakhs. Now, let's say I need to pay 6 lakhs in 1 year, right? If I can invest that in a savings account at a 2% rate, then I don't actually need 6 lakhs today to pay 6 lakhs in 1 year, because I can invest it and earn 2%. So if I divide by 102%, I find out that I actually only need 5.88 lakhs. And the same principle carries for, if I need to pay 6 lakhs in 10 years, then it becomes only 4.9 lakhs. And that's the calculation the present value is doing. It is saying you want to pay 6 lakhs for 40 years, right? And you want to do that with the expenses growing 5% and the investment growing 7%. So how much do you actually need in your corpus to satisfy that today? And it's summing all these up together. And that's the number that's working out to 1.5 crores. So that's kind of how it works mysteriously. It's a bit complicated, but you can view this video again and again to understand intuitively what's going on, for those that are curious how this mysterious number is being calculated. But the math is logically sound and works. So that's kind of how you work out the size of the policy you need. Okay, so the last thing I'm going to cover in this session, and then we'll cover more in the next session on insurance, is some basic jargon on common terms in insurance. So there's, and this is jargon that's used in almost all of these policies. So the sum assured, if you hear that term in insurance, that basically means the amount the insurer would pay if the event occurs. That's how much they're covering you for. So if the sum assured is 1.5 crores in my life insurance policy, that means if I were to die during the period of the policy, the insurer would pay me a 1.5, my family, a 1.5 crore settlement. And the term is how long the policy lasts. So when an insurer insures you, typically, unless it's a whole life policy, the insurer will not be covering you for an indefinite period of time. There's usually a fixed term. And so I may be taking insurance for 5 years, let's say. That means if my death were to occur in 5 years, then the insurer would pay the sum assured. Otherwise, tough luck, the policy is out of term. I would need to renew my policy in 5 years for the insurer to keep coverage. And then the premium, as we discussed, is the fee that is paid to the insurer for taking this risk. The insurer, as we discussed, is not going to take this risk for free. They're going to charge you a premium to make a profit on taking that risk for you. And then we have the deductible. So sometimes an insurance policy has something called a deductible where you are taking some of the risk yourself. So a good example of this is auto insurance. A lot of auto insurance policies may have something called a deductible, which says if you get into an accident, the insurer will pay, let's say, 5 lakhs, up to 5 lakhs or whatever. And you would need to cover the first 1 lakh. And that's called the deductible. It makes sure that you have some skin in the game if the event were to occur, and it can reduce the cost of insurance, because that way the insurer thinks you're safer because you also have some risk that you're taking. This is not at all common in life insurance policies, but more common in general insurance. The claim is when you want an insurer to pay because an event has occurred. You have to file a claim with details of what happened, and the insurer then reviews the claim against your policy. It makes sure that you didn't violate your policy at all. And if you did not violate your policy, and this is really, really important because a lot of people don't understand the terms of their policy, you need to read the terms of your policy, then they'll pay you the claim. The settlement ratio tells you how often on average an insurer has agreed to pay the claims of a customer versus rejecting a claim. So when you're evaluating which insurance company to pick, you want to look for companies that have a higher settlement ratio. It means that they're honoring their claims more than other insurance companies. And that's a very good thing because you're relying on the insurer to honor your claim. And you want to have the peace of mind that these guys are actually going to pay if something adverse happens. Okay, so I think this is a useful first session. A lot we covered, so I don't want to overwhelm you guys on everything. So our next session is going to be our last in the beginners series that we just did. And it's going to continue with protection. And I'm going to give you my final recommendations for using insurance well. And the other thing I'm going to cover is why we shouldn't use insurance as an investment. This is something that's very common in the Indian market, which is not at all common in the US, where people use insurance not just for protection, they actually use it as a savings instrument. And many of you probably have, an LIC policy or a ULIP with ICICI Pru, or, and typically these are not great products to use. I'm going to get into more about why in the next class on this. But the short answer is it's very difficult to understand how much you're actually paying for protection and how good of a rate of return you're getting on these policies, because the two are mingled together. And the performance of these products has not been very good compared to relative to plain vanilla mutual fund products. And then I'm going to conclude the session with the holistic view of how all the 4 pillars work together to ensure financial health for you. And if you really study these pillars well, know how to use them to work for you, it sets you on the path to have a very prosperous financial life and to retire with security and peace of mind. And that's really the goal of personal finance, as we discussed in the first session. How do we steward ourselves through this life with ups and downs coming in many, many ways, shapes, and forms to ensure that we can retire with confidence and security when the time comes. So with that, I'm going to open it up for any Q&A on this insurance topic.
Okay, so there are a couple of questions. The first one is, I've heard the concept of self-insurance. What is that? I've also heard of term life insurance in India, and the fact that it's much higher than in the US, even though life expectancy in US and India is the same and admin costs are lower in India. Why is the premium higher in India?
Okay, both very, very good questions. So in terms of the first question on self-insurance, so self-insurance, if you recall, there are three ways to handle protection in your financial health. The first is savings, second is borrowing, third is insurance. When you self-insure something, it basically means you're opting not to use the insurance tool to protect you. And that may be a wise decision if you have the savings cushion to insure yourself against it, right? So the first step in asking whether you need insurance is whether you have the savings to handle this risk yourself. Let's say I was Mukesh Ambani, okay? And I had so much in savings that even if I died, you know, my great grandchildren have enough of a corpus to be fine, right? Why on earth would I ever buy life insurance, right? Because I can self-insure any risk. If I die, my family is okay because they have so much in savings. So self-insurance is basically that. It's when your savings are large enough to absorb any risk that could occur, and you don't need to pay an insurer to take that risk. Another example could be, which is more relatable, you know, I have a decent amount of money, let's say. I have a pretty affordable car. By law, I need to have some level of auto insurance, but I don't need a comprehensive auto policy. So if I look at the math, I say, okay, what's going to happen if my car gets in an accident? Any damage that occurs to the other person's vehicle will be covered by my insurance. But do I need protection that happens to my vehicle? And if I look at my corpus and I say, you know, the max value of this car right now is, let's say it's 5 lakhs, right? I can take a 5 lakh hit if my car were to get into an accident tomorrow because my corpus is big enough. I am going to self-insure. I'm only going to opt for a partial policy. So that's an example also of self-insurance. It's when you're opting to take the risk exposure yourself. You're saying, you know what? I don't need help in insuring this risk. I have enough of a corpus to manage it. And the second question was around term life, and it was around the rates of term life insurance abroad and in India. So I think it's a very good question. I haven't studied the rates of term life insurance in India versus the US. So this is all speculation, but I think it's such a great question that I'm going to actually look into it and figure out if this speculation is correct or not. But just to repeat the question, it's why is the rate higher in India for the same sum assured than it is in the US? My specs are similar. They're not the same in the US and India. India has a lower life expectancy level than the US. It may not be dramatically lower, but it doesn't take a lot of variation in that. So in India, even though the average may be not that different from the US, the variance in outcomes is very high. So when an insurer insures someone in the US, they have a fairly good idea of this person will probably live till, let's say, 80, right? When they do the same calculation in India, there may be more uncertainty in terms of whether that person reaches the mean level of life expectancy or not. So that could be one thing. Also, the size of members that are actually, the size of insured people is much lower in India than it is in the US. Even though we have so many more people in India, the insurance penetration is very, very low. I think we only have around 8% or something life insurance penetration offhand in the US, but probably 30-40% in the US. So insurers love the law of large numbers. They want to see lots and lots of people in their pools because they know that with more and more people, there will be more security that their rates, the settlement rates will converge towards the mean. Because there are fewer people using it in India, it also may create more uncertainty in the insurer's mind about how much they need to uh, charge to make sure they're profitable. The other factor is the cost of capital. In the US, interest rates are very, very low. And insurers, like any financial institution, have to return money to their investors. And when interest rates are high, right, they have a high opportunity cost of that capital. So India, there's high interest rates, so they need to make sure that they can return enough profit. They have to charge more to their users, to their customers. That's another big factor. And the last factor that could also be explaining that divergence is the rates of insurance fraud. Insurance fraud, and this is a topic that I probably should have included a slide on this in buying life insurance or any form of insurance. You may be tempted to fudge the details a little bit to get a lower questions on a life insurance form. Maybe, do you smoke? The reason the insurer is asking you that is if you smoke, the risk they're taking is much, much higher. So they're going to charge you a higher rate than if you don't smoke. You may be tempted to lie on that form or whatever to get a lower rate and premium. That is called insurance fraud. And that's something that you definitely do not want to do, because if you get caught doing that, your entire policy is void and the insurer will not honor your policy. So you should always be fully transparent with insurance companies and use insurance with full transparency and honesty, because the truth of the matter is insurers investigate a lot of claims that they get, and particularly in areas where insurance fraud is high. So one of the reasons we may have higher rates is also because there are higher rates of insurance fraud in India than there are in the US. So a lot of factors. My guess is the main ones are probably the interest rate and the life expectancy and variance around that.
Okay. So I've heard the term no frills insurance. What is this?
So no frills insurance means basically opting for a basic plan of an insurer. And this is something that I really recommend most people get, is a basic plan, because insurers love packaging in more features into their insurance because they can charge customers more and more of a premium on them. The issue with these is it's very hard to price compare them to other policies. So for example, they may have a feature like, if you buy this life insurance policy, it covers 7 critical illnesses and you can pay an extra X rupees to cover, 2 more critical illnesses. And generally when they're offering you things like that, they're coming at very, very high premiums, because they've already got you as a customer. You're getting down to signing the paperwork, etc. They have your attention and they're trying to upsell you. And typically these are not very good deals. So our general advice is opt for no frills insurance policies wherever required. If there are special circumstances where you need to have extra frills because there's particular risks that you want to cover, by all means opt for the risk, but make sure you compare the price on that top-up feature with other insurance companies also.
Okay. I think there was a typo on the slide. It should be net growth of corpus. So
Probably, I don't know which, let me
uh,
see, which slide? Net growth of, yes, correct. Sorry. Net growth of corpus. Correct. The
so
members,
someone has
exactly.
asked a question on, is insurance required for people who are about to retire?
Very good question. The answer would be what type of insurance, right? Would depend on what type of insurance. Is life insurance needed for someone that's about to retire? My answer would be probably not in most circumstances. Why do we buy life insurance? We buy life insurance to protect the risk that an salary stream goes away in the future, an income stream goes away in the future. If I were to die, why do I buy life insurance? Not to help the emotional impact of the loss, right? I mean, that's not why we buy life insurance. It's to prevent the financial impact of the loss. If a family is retired, there is no income that is being generated through my living, right? I'm not working to generate income. So I do not need to protect that income stream. And that's really why we're buying life insurance. So in most cases, life insurance doesn't really make sense. And the other reason is that it becomes very expensive the older and older you get. Life insurance is very cheap when you're in your 20s. It's even pretty cheap when you're in your 30s. Even in your 40s, it's not terribly expensive. Once you start getting into the late 40s, 50s, 60s, it climbs astronomically because the odds of death increase significantly in that period, right? So once you're retired, it becomes prohibitively expensive for most people to get life insurance also. So that's another factor why it typically doesn't make sense to get life insurance. But you still may want other forms of insurance. You still may want a comprehensive auto insurance. You still may want property insurance on your home, because those are things you need to protect, whereas you don't need to protect a salary anymore.
Okay. There's a kind of linked question on investing. So investing in insurance companies should be looked into? That's the question.
So in terms of the stocks of those companies,
in reference to stocks, yes.
In reference to stocks, I think the insurance sector in India is pretty interesting because life insurance is so underpenetrated. There's definitely the opportunity for the life insurance sector to gain more share in India. So I definitely think it's a sector that could experience growth. And in terms of, whether it's an interesting sector, one part is, does the sector have good prospects? Yes, it does. The second thing that you must evaluate is how expensive are the stocks. So you typically look at insurance companies on book value. So you really want to understand what book values they're trading at, etc. So, it's a sector that intrigues me. I've not studied it very carefully, so I don't have a personal view at this point right now, but it's definitely on my list of sectors that I want to do a deep dive in at some point.
Okay. There have been a couple of recommendations for a session on retirement. So I think that's something that we should look at post these beginner sessions.
I think that's a great idea. I think we'll definitely do one on retirement, and I think one of the things that I've observed is people do not necessarily have as much confidence as they should when they retire. So one of the sessions that I'm really interested in doing along that lines is how to realize how much power and control you have within retirement, and how to live a very fulfilling life in retirement, and realize you're not that insecure even though you're not earning that salary, etc. So I think definitely we'll cover something on retirement, a series on retirement. Great idea.
So that's it for the questions for today. So I think we can call it a day.
Great. Okay. And like I said, there will be no Bharosa only session next week. We'll be doing a joint session with Small Case. I will send the login details and all in all our lists. And that session will require, I think, sign up in advance. So just make sure you do the signups, etc., in advance. And it'll be on stock investing again. So it will be a topic that a lot of interest will be there on, and it should be a very good session. So thanks guys for joining, and see you next week, hopefully. Bye.